Welcome everyone to today's explainer. We are going to take a really fun, zoomed-out, masterclass approach to understanding how the macroeconomy actually works. We're going to look right past all that intimidating jargon and uncover the hidden mechanics that quite literally drive the world around us. So get comfortable and grab your mental notebooks because we have a truly fascinating journey ahead of us today.
And like any good syllabus, here is our roadmap for today. We'll start with the economic building blocks, then move into measuring national wealth, followed by the saving and spending game, and finally we'll decode the inflation puzzle.
All right, let's jump right into Section 1, Economic Building Blocks.
Now, before we can even begin to look at complex charts or, debate massive national budgets, we have to ask ourselves a very basic foundational question. How do we even begin to measure the moving parts of an entire country's economy? I mean, it's a massive undertaking. We have to know exactly what we're counting, and honestly, more importantly, when we are counting it. And that brings us to an absolutely crucial distinction in economics: stock versus flow. To wrap your head around this, just picture a bathtub. Think of water flowing from the tap. That water is a flow because it's being measured over a specific period of time, right? Like a month or a year. Your annual income or your monthly savings, those are flows. Now, imagine that water filling up the bathtub. The water sitting in the tub represents your static stock of wealth. It's measured at one specific point in time, like checking your total bank balance today. Understanding this difference helps us separate what is currently being generated from what has already been accumulated over time.
Moving on, another vital building block is distinguishing between final goods and intermediate goods. We have to do this to avoid double counting our economy's output, which would totally mess up our numbers. It is all about the end user. So, say your family buys a glass of milk at the store and drinks it. That milk is a final good. It's been consumed, end of story. But if a local sweet shop buys that exact same milk to make sandesh, a really popular sweet, well, now that milk is an intermediate good. It's just a raw material used to make something else. We only count the final sandesh in the national accounts to make absolutely sure we aren't counting that same milk twice.
Okay, Section 2, Measuring National Wealth. Let's zoom out. So there is actually a massive difference between domestic income and national income. Domestic income, which you probably know as GDP, is strictly about geography. It is everything produced inside a country's physical borders, regardless of who makes it. But national income? That's about citizenship. To find it, we take our domestic income and we add something called net factor income from abroad, or NFIA. Basically, we add the wealth our citizens generate overseas and we subtract the income that foreign workers generate inside our country and send back home. If that NFIA number is positive, our national income is actually higher than our domestic income. It's kind of like borders versus passports.
But how do we get from that massive, abstract GDP number down to the actual money sitting in your wallet? Well, to figure out what ends up in your pocket as personal income, we have to peel back the layers step by step, almost like an onion. We start with the big GDP, then we subtract the everyday wear and tear of machinery, which is known as depreciation, then we subtract indirect taxes, add in that foreign income we just talked about, and finally strip away corporate taxes and undistributed profits. Only after all of that do we arrive at personal income. It's a really great reminder that the big headline GDP number you see on the news is definitely not the same thing as household wealth.
Alternatively, we can calculate everything using what's called the income method. Instead of tracking all the goods produced, we just simply add up everyone's compensation. Think about it. If you own land, you get rent. If you provide labor, you get wages. If you provide capital, you earn interest. And if you are an entrepreneur, you earn profit. We also toss in mixed income for self-employed folks, like local small business owners, where you can't really easily separate their wages from their profits. You just add all these pieces together, and boom, you've got the total national income.
And remember, there are two distinct ways to look at the price of all these goods: market price and factor cost. The market price, which is what you actually pay at the store, includes indirect taxes. So for example, if a product costs 90 rupees to make, and the government adds a 10 rupee GST, the market price is 100 rupees. But the factor cost, which is what the producer actually receives to pay their workers and their rent, well, that's just the base 90 rupees. We always have to subtract those indirect taxes and add back any government subsidies to find the true underlying factor cost.
Which brings us to Section 3, the saving and spending game. This is where human psychology gets involved.
Meet one of the single most important concepts in all of macroeconomics, the marginal propensity to consume, or MPC for short.
It measures exactly how much of a brand new dollar of income you will spend versus how much you will squirrel away for later. Let's say your income goes up by 100 rupees. If you decide to spend 80 rupees and save 20, your MPC is 0.8. And because you literally always have to either spend or save your income, your propensity to consume plus your propensity to save will always equal exactly 1.
Let's visualize this with the saving function. If you look at lower income levels, you might actually have negative saving, which economists call dissaving. This makes total sense, right? Because even if your income suddenly drops to 0, you still have to eat and survive. So you dip into your past savings or you borrow money. But as your income increases, you eventually hit a break-even point where your saving is exactly 0. Beyond that magic point, your savings finally start climbing into positive territory.
So, saving is obviously great for securing your personal financial future. But here is a truly fascinating, kind of mind-bending question. If saving is good for an individual, what happens to the whole economy if every single person suddenly gets scared and tries to hoard their cash all at once? This brings us to the climax of this concept, the Keynesian paradox of thrift. Here is how it plays out. If people suddenly want to save more, they stop buying goods. Right away, aggregate demand plummets. Factories start seeing their unsold inventory pile up, so what do? They cut production and they lay off workers. And ironically, because everyone's income just dropped, our total national saving ends up falling, or at best, just staying exactly the same. By all trying to save more, we actually ruined our collective ability to save. This paradox hits especially hard during economic depressions.
The underlying reason this thrift paradox happens is because of something called the investment multiplier. In our economy, one person's spending is literally another person's income. If a company invests 100 rupees to build a new machine, they pay workers. Those workers then take that money and spend a portion of it, which is dictated by their MPC at the local grocery store. The grocer then spends that income and the cycle continues. A single dollar spent ripples through the economy multiple times, amplifying the impact of our collective spending habits. If the MPC is 0.8, every new dollar invested actually creates 5 whole dollars of national income. It's a massive ripple effect.
All right, final section. Section 4, the inflation puzzle.
So, when prices go up across the board, it usually happens for one of 2 distinct reasons. First, we have demand pull inflation. This is your classic too much money chasing too few goods scenario. Aggregate demand shifts upward, pushing prices higher. Alternatively, we have cost push inflation. This happens when the actual cost of production spikes. Say, raw materials suddenly get super expensive, which causes the overall supply to drop. Supply drops, and again, prices are forced upward.
To track this inflation, governments rely on 2 main yardsticks. The Consumer Price Index, or CPI, measures a fixed basket of everyday goods that a typical household buys. And crucially, CPI includes imported goods. On the flip side, the GDP deflator looks at the price changes of all final goods produced domestically in the entire country, but it uses a changing basket of goods and completely ignores imports. So they give us 2 very different lenses to view the exact same inflation problem.
Now, to manage the economy during these inflationary times or during deep recessions, governments will step in. One tool they use is transfer payments. These are payments like unemployment benefits, pensions, or disaster relief. But here is what's vital to remember. Transfer payments are not counted in the national income. Why? Because the person receiving the money isn't providing any new goods or productive services in return. It's simply wealth being transferred from one part of the economy to another. No new wealth was created.
And how exactly does the government pay for everything? Well, through their receipts, which fall into 2 main buckets. Revenue receipts are regular income, things like income tax, GST, or fees. They are great because they don't create any debt for the government. But for massive, long-term infrastructure projects, governments have to rely on capital receipts. This includes taking out big loans or selling off government assets. Capital receipts give an immediate cash injection for sure, but they either create long-term debt or they reduce the nation's total assets.
So, as we wrap up this masterclass, I want to leave you with one final kind of provocative thought. We've seen how stocks and flows build an economy and how one person's spending magically becomes another's income through the multiplier. The next time you're standing at a cafe deciding whether to save your money or spend it on a coffee, ask yourself, how is your personal micro-budget secretly moving the needle on the entire macroeconomy? Thanks for joining me on this explainer, and keep questioning how the world works.